We begin with a historic jump in borrowing costs in the world's largest economy. Rising prices of food, fuel and other products have driven the US Federal Reserve to hike its benchmark interest rate by 3/4 of a percentage point. That's the sharpest increase in interest rates since 1994. Now, it means short-term lending rates in the US now range between 1.5% and 1.75%. Officials hope the move will help to bring down inflation, which stood at 8.6% in May, much higher than the Fed's target of 2%. But the rate hike is expected to slow down economic growth. Federal Reserve Chairman Jerome Powell says GDP growth will be less than 2% through 2024.
The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 3/4 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
Other central banks are also swinging into action to tame rising prices. The Bank of England raised its lending rate by 25 basis points to 1.25%. That's its fifth consecutive rate increase. Switzerland has held its benchmark interest rate at minus 0.75% since 2007. That's now been raised to negative 0.25%. And the European Central Bank says it intends to raise rates multiple times this year.
We intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook.
Well, let's get more on this now with Claus Vistesen, Chief Eurozone Economist at Pantheon Macroeconomics. He joins us now from London. Really good to have you back with us, Claus. So the Fed's biggest rate increase in almost 3 decades. Do you believe this is the right move, and will it work to tame inflation?
Well, as far as being the right move is concerned, I mean, we're a little worried that the Fed might over-tighten here in the near term as it chases inflation. But in a way, after we got that inflation report from May, which again was an upside surprise, I mean, the Fed probably didn't have any choice but to go shock and awe. And right now, they're going to take it 1 month at a time. But, if we get an upside surprise again in the June inflation report, we could see 75 basis points again next time. So right now, the Fed is definitely an inflation fighter, and they're chasing inflation higher here. And so, maybe, in 6 months' time, if we speak again, we can look back and tell a different story. But right now, I think it's pretty clear what the story is. And, the Fed is going to keep hiking. That's for sure.
The very idea behind raising interest rates is to effectively deter people from spending, and that reduced demand is hoped to bring down prices. But that could also, in turn, slow down economic growth. We might also see job losses. So do you believe that perhaps we could run the risk of a global economic slowdown and a global recession?
Well, obviously, I mean, if you look at the pace with which global monetary policy is being tightened at the moment, it's not just the Fed. The European Central Bank is raising interest rates as well, the Bank of England, even the Swiss National Bank. Of course, in these kinds of circumstances, there's always a risk that the economy is pushed into recession or pushed into a slowdown. But the problem is that, if you look at the supply side, there's not much we can do. The supply is fixed in the short term, right? I mean, at least that's sort of classic macroeconomics. We can't really move the supply side a lot. And so when you have a mismatch between the two and demand is too strong and inflation is strong as it is at the moment, your only choice as a policymaker is to lean on demand. And as you say, that means, in a slightly cruel way to push unemployment up and demand down in a sort of traditional macro model. And that's what's happening at the moment.
The question that a lot of people are asking is how much higher do interest rates need to go to actually have a meaningful impact on inflation? I mean, you mentioned that the Fed has indicated that it will be looking to further tighten its monetary policy. But in your view, how much higher do interest rates have to go?
Well, so that is obviously the $64,000 question. Look, I think if you look at financial markets at the moment, they're pricing in a terminal rate for the Fed at 4%. We probably think that's slightly too high, but we are going to take it one step at a time as well in terms of forecasting. I mean, we think in the near term the Fed is definitely going to chase inflation higher. And therefore rates are going to go up a lot. We also fear, though, that the Fed might be over tightening, so that we see a risk or an opportunity, if you will, depending on how you position the markets, that as we get closer towards the end of the year, the Fed will get an opportunity to at least dial down the pace of hikes, right? So that means we're not going to see 55 or 75 basis points hikes, but we're going to go back to sort of more moderate 25 basis points hikes.
Okay, Claus Vistesen, we'll have to leave it there, but really good to get your analysis. Thank you for joining us.
Thank you.